If you trade ICT concepts, you've probably heard this before. Price always comes back to fill the fair value gap. But what if I told you there is no gap to fill? In this video, I'll show you why fair value gaps aren't a real market phenomenon, why they completely fall apart when you change timeframes, and what part of the move actually matters if you want a real trading edge. Stay with me, because once you see this, you won't be able to unsee it. Let's start with something important. Fair value gap is not a standard market term. You won't find it in Investopedia or classic market literature. It's a branded concept popularized by retail trading influencers. A fair value gap is usually defined as the price range between the high of one candle and the low of a later candle, skipping the candle in between. The claim is that this gap represents thin or missing liquidity, and that price is drawn back to it like a magnet. It sounds convincing, but here is the problem. The gap isn't real. A fair value gap exists only because of how candlesticks compress price data on a specific time frame. Candles are not price itself, they're just containers. Change the time frame, zoom in or zoom out, and that gap shifts, shrinks, expands, or disappears completely. What looks like a clean textbook gap on one time frame resolves into normal, continuous price action on another. There is no actual untraded area between those wicks. Orders did transact there. There is no invisible vacuum, no missing liquidity, and no structural force pulling price back. They are charting artifacts, not market phenomena. Let me show you exactly what I mean. On the original chart, you'll see what looks like a perfect gap. Zoom in one time frame, and the gap is smaller and messier. Zoom in again, and suddenly it's gone. What you see instead are overlapping candles, full of trades. If fair value gaps represented a real void in liquidity, they would exist consistently across all timeframes. They don't, because they are a side effect of candlestick compression. The market traded there, you just can't see it on that chart setting. The idea that price must return to fill a gap is built on an illusion. If you're getting inconsistent results, this is why. ICT traders often say these gaps represent unanswered price, claiming orders weren't matched there, so price must return to resolve the imbalance. That isn't how markets work. Price is simply the last traded level. Every single tick exists because a buyer and a seller agreed to transact. There are no skipped zones. If price moves quickly, that just means aggressive orders swept the order book. Liquidity was crossed, not left behind. Think of water rushing over rocks in a stream. The flow is fast, but it doesn't leave an empty hole behind. Markets revisit levels all the time, but they don't need mystical gap-filling rules to do it. They naturally mean revert and consolidate. That's normal behavior, not evidence of an invisible magnet. Another issue is that fair value gaps appear constantly. If you look at a 15-minute chart and don't delete old failed gaps, the chart is absolutely littered with them. They form so frequently that it's impossible for all of them to mean something. When a signal appears dozens of times per session on every time frame, it isn't a signal. It's noise. This is why trading every gap doesn't work. At best, it just highlights where an impulse candle occurred, and that is the part that actually matters. Here is the uncomfortable question. Where is the proof? There are no academic papers disproving fair value gaps because no one serious has considered them worth studying. In professional finance, ideas without a clear definition, a measurable mechanism, or testable rules get ignored. If they truly had predictive power, there would be rigorous studies with statistically significant results. We just have cherry-picked examples and marketing narratives. Real edges survive scrutiny. Narratives don't. So what is real? The impulse. A strong displacement candle tells a real story, that one side of the market became aggressive, fast. Buyers or sellers overwhelmed available liquidity, forcing price to expand rapidly. That information matters because aggression changes market behavior. The impulse can signal strength, volatility, expansion, or short-term exhaustion. So how do you use this correctly? Treat the impulse as evidence of aggression. Bias trades in that direction until the market proves otherwise. Look for normal pullbacks into the base of the thrust because markets routinely retrace after momentum. Adjust risk expectations because volatility is elevated after an impulse move. Stop trading the artifact and trade the aggression. Discard the fairy tale of gaps that must be filled. The real edge is recognizing when the market just fired a cannon shot and knowing how to trade what comes next.